Sometimes it's better to be lucky than it is to be good. And what I'm talking about is Abercrombie & Fitch. We just made a video on the channel about Abercrombie & Fitch, and it was one of the companies that I decided to invest in just a couple of days ago. And here today, at one point, this stock was up by over 34%. And this massive move up in the stock price came after the company announced their first quarter 2025 earnings, which crushed analyst expectations. But before we get into all of that, make sure you stick around till the very end of this video because we will be diving into my personal portfolio. And if you enjoy this content, drop a like down below and subscribe for more videos like this one. In terms of their top line numbers, they put up revenue of $1.1 billion. That was up year over year by 8% and beat analyst expectations by around 2.5%. For their bottom line, they put up $1.59 of EPS. This is actually down significantly year over year when in 2024 in Q1, they put up $2.14 of EPS. However, this $1.59 beat analyst expectations by almost 20%. And really the reason their profit was hit so significantly has to do with tariffs. This increased their cost of sales significantly. It went up to 38% from a year ago when it was sitting at 33.6%. And ultimately, this trickles down to their operating margin. Their operating margin for this quarter came in at 9.3%, which is down from 12.7% a year ago. And ultimately, all of this comes back to tariffs because Abercrombie & Fitch gets a lot of their clothing from Southeast Asia. The company is projecting that a 30% tariff on China, as well as a 10% tariff on a number of other countries, will have a $50 million effect on the business. However, this is still a company with very impressive brands. Their main brand is Abercrombie. Abercrombie saw their sales this quarter decline by 4% year over year. However, this makes a lot of sense when you look at their target consumer. Their target customer for this brand is 23 to 40-year-olds. These are customers that are post-grad, they love to travel, they are fashion obsessed, and they are digitally led. Digitally led is very important because 60% of their sales from Abercrombie actually come from digital markets. This is important because they can generally get higher margins if they're selling things directly off of their website versus in stores. 40% of their sales came from in stores. If you think about this consumer in the age range of 23 to 40 plus, these are people who are established or starting to get established in the real world. So things like tariffs have a bigger effect on them and could result in them pulling back on some of their spending. Their other major brand is Hollister. Hollister is focused on a customer base that is 13 to 21 years old. This is very important because this customer base is financially reliant. What that means is they are reliant on their parents in often situations to actually pay their bills, to pay for food, to pay for things like living, for clothing, things like that. So what that means is this customer base, if they have a job and they have spare income, all of that income is going towards things like clothing or eating out. And when it comes to clothing, where are they shopping at? They're going to malls with their friends and they are buying clothes from companies like Abercrombie & Fitch. And that's why for this brand, you see 70% of their sales coming from stores and only 30% coming from digital online sales. So when it comes to tariffs, these teenage customers are a little bit more resilient to the fluctuations that you might see on some of these goods. Also, Abercrombie & Fitch is doing an excellent job of advertising to them by showing a lot of their products through influencer channels, social media marketing, through TikTok, as well as Instagram, as well as affiliate sales. These are all great tactics that a lot of other brands have started to incorporate over the last few years. Another company that has done a very good job at this is Elf Beauty. And here's the thing. Once we see these tariffs go away, which I firmly believe that in the future they're going to go away, we are going to come to some sort of trade deal. That will have a major impact on Abercrombie & Fitch and their bottom line numbers. We saw a year ago them put up an operating margin of over 12%. Right now their operating margin is sitting at 9.3%. So if we start seeing some of these things go away, there is no reason that Abercrombie shouldn't have an operating operating margin between 10 and 15%, which should massively increase their EPS. However, here's something to keep in mind. In terms of their full year guidance for 2025, they have dropped a lot of their numbers. Their previous guidance for operating margin was sitting between 14 and 15%. They have now dropped that to 12.5 to 13.5%. They also dropped their EPS expectations from $10.40 to $11.40 down to $9.50 to $10.50. But my opinion on this is there are just too many unknowns for these companies to try and project these numbers. They are trying to count in all these tariffs staying in place. They're trying to factor in what level are these tariffs going to be at. And because of that, they are trying to be as conservative as possible. That is my opinion on what the management team is trying to do here at Abercrombie & Fitch. They don't want to factor in too much and mislead investors. And you can even see that in some of their other numbers because they actually increased the range for their net sales. It was previously sitting at 3 to 5%, and now they actually increased it to 3 to 6%. So it's almost like they're actually expecting their revenue to increase for this year. And what I mean by that is their revenue growth to actually increase beyond what they previously expected. And this is even kind of shown in their store openings. They are expecting 60 stores to open this year. That's the same as their previous guidance. However, they previously guided that they were going to close 40 stores. Now they're only expecting to close 20 stores. My assumption with this is that they are seeing something change with those 20 stores. They are potentially seeing income and revenue and more profit coming in from those stores than they had previously thought. And because of that, they are electing to not close those stores. So ultimately, when it comes to Abercrombie's numbers, their top line revenue is sitting around $5 billion. This is a massive increase over the last 2 years because back in 2023, they were bringing in around $3.7 billion. So we have seen their revenue increase significantly in a very short period of time. And this hasn't just been growth for the sake of growth. This has been profitable growth. Right now, their EPS, or actually prior to this last earnings, it was sitting at $10.69. That'll be down slightly with their newest earnings because again, a year ago, they put up around $2.14. We have seen them put up $1.59 in this most recent quarter. So there will be a slight decline. However, that is still, again, a massive increase from where they were even back in 2021 when they were bringing in around $4.40 of EPS. However, despite these significant increases in both their top and bottom line numbers, the stock is currently trading at a price similar to where it was at the end of 2023. If we look just a few months ago, back in June of 2024, the stock price was around $185 per share. And even at the start of this year, it was trading around $160 per share. We saw some bad guidance leading into this tariff situation that sent the stock significantly lower. However, it is still down far below where it was just a few months ago. And if we see this tariff situation turn around, I personally believe that we will see their margins increase significantly and EPS get back to growth. And that, along with the fact that this company is currently trading at a forward P ratio of a 7, is why I added it to my portfolio. We can look just around a year ago, this stock was trading at a PE ratio of a 16. That is over double where it currently is at. That means the stock, purely based off valuation, could double in price from its current levels. The problem I always seem to run into is that I don't buy in heavy enough when I buy into these companies. This is the YouTube portfolio. It's currently sitting at a value of just over $65,000. And after the video we posted on Monday, we purchased Abercrombie & Fitch on Tuesday, as well as Hawkins. Abercrombie & Fitch, we bought just over $1,000 worth of the stock. And right now, we're up almost 21% on this position already. Hawkins, we bought around $600 of the stock, and we're up around 4% already. Like I said, this is basically just luck. We got lucky that the earnings were good, and overall the stock moved up in a massive way today. On top of those positions, we also hold Google, Supermicrocomputer, Microsoft, AMD, Adobe, SoFi, PayPal, Alibaba, Palantir, Apple, and we have a solid cash position of around $17,000. But like I always say, don't buy a stock just because some randomly lucky guy on YouTube did. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day.